Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Josef Schachter, founder of the Schachter Energy Report online at SchachterEnergyReport.ca. He's speaking to us from Calgary, where they're enjoying the same strong winds Vancouver got to experience a day ago. Welcome back to the show.
Jim, it's a pleasure to be with you again.
Joseph, OPEC has excess production and has put pressure on cheaters by Saudi Arabia. What's the deal there? Are they disobeying their own guidelines?
Well, they were more optimistic about the recovery, and they were expecting that demand by now would be about 95 million barrels per day. And it looks like it's more like 92.4. Proof of that would be the U.S. Data that just came out, this week for the storage. And the U.S. demand is still 2.76 million barrels less than a year ago. So if we were 100 million, then that takes you, with the U.S. and what's going on in Europe and South America, Canada, and if you assume China's back to full, you're still talking probably about 7 million barrels less than the 100 million, and that's why I think that 92 is a disappointment. So OPEC had a virtual meeting last week and said, we got to get guys to rein in their excess cheating. But in July, they increased production by 980,000 barrels a day to 23.2 million. Of that, 866,000 to 8.4 million was Saudi Arabia. In August, they raised production, OPEC as a whole, 763,000 barrels, of which Saudi increased 475 to 8.9, and they're now producing 24.0. The problem is, if you take world demand for the year, and you take what's the call on OPEC when you minus out non-OPEC production and non-OPEC and OPEC NGLs, you end up having a call on OPEC for the rest of the year of 22.6 million. So with production at 94 or at 24, you have 1.4 million barrels a day too much production, and that's really the basic issue. And so you've got problems where China was buying a lot for their storage, for their strategic petroleum reserve. They've stopped buying. And then there's one more problem that OPEC has, and that's Libya. Libya at one point was producing 1.2 million barrels a day in the fourth quarter of 2019, and now they're producing, because of the war, about 100,000 barrels a day, 106,000 in the month of August. And so if they're able to reopen their fields, that will add another 1 million barrels a day to complicate things. So we're looking at probably a build of inventory September, October, November until winter in December. And that, I think, is going to drive prices down for crude. And we're hovering around 40, which is an uneconomic level for most companies. And I think there's a high risk that we go below US $30 a barrel. I don't see us having the same problem like we did in February, March, April, when we went into negative pricing because of hedge fund activity, because of the ETFs. But I do see a risk that we go below 30, and that's why I think people should be sitting in cash, which I've been talking about for quite a while. And as you know, I've been talking about a break of 40 in previous discussions. We've done that, and we've been as low as 36, and I think we're going to see a breach here in the next few weeks that takes us and heads us towards below $30. And the oil and gas index, which we talked about and said in June that it was getting a little lofty, it's been hit pretty hard here, about almost 30% since then. And we've seen the oil stocks get hit more, the Suncors, etc. and today we're trading around 68 on the index. And the names like the Suncors have been really hit. Suncor is trading today at just under $17, and this stock going back in June was trading at $29. So that just shows you how tough it's been on some of the oily energy names. And the natural gas names have done somewhat better. And as we've talked before, we've liked the natural gas names over the oil names. And we prefer light oil to heavy oil.
Do you see an end to the civil war in Libya anytime soon?
Well, it looks like the Haftar, the General Haftar in the eastern part of the country, has won, and there's been reports that the government in the west has resigned, and it looks like Turkey, which was backing them, is lost to Russia, and the UAE and Egypt that have been backing the eastern part of the country. So if that is the case and a government of reconciliation or whatever you want to call it is formed, then they're going to want to get money right away to recover and rebuild their economy. Remember, it's a war-torn country for a number of years. They could probably bring back 300,000-400,000 barrels in a week or two, and then over time, as any pipelines that have been disrupted and the ports that have had problems rebuild. My guess would be by the second quarter of 2020, they could be back over 1 million barrels of production. That will just exacerbate the problem for OPEC.
We'll have more with Josef Schachter right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Josef Schachter. Joseph, what's the story with natural gas?
Well, natural gas, the drilling industry, as you know, the number of rigs have gone down so much that we've got a very low activity level, and we've seen a decline in production in the United States. At one point, they were doing about 104 BCF a day, 9 months ago, and now we're down to 94 BCF a day, and that number is continuing to fall. And in Canada, the same kind of thing because of drilling activity coming down. And of course, in Canada, we're fortunate that we have very low inventories and more takeaway capacity coming and more demand within the province coming because the switch from coal to natural gas, and as more natural gas-fired facilities and more takeaway pipeline capacity comes on, the United States is sitting with very high inventories because the LNG business got destroyed because of COVID, and there wasn't the shipments that were supposed to be happening. But there's now talk that China and others are starting to buy more LNG, so the supply and demand will get into balance. And then if we do have a cold winter, I wouldn't be surprised if we were looking at, instead of, $2.30, $2.40 for NYMEX right now, that you're looking at $3.50 to $4. And AECO, which could be, around $2.50, we could see $3 to $3.50. The industry break even for many companies is $1.50, $1.75. So when you're around $2, they don't make much money. But you add $1 on top of that, they really do well, and they really coin it in the winter months when you can see $4 and $5 prices for short periods of time. So I think that we're going to see, even though I'm looking for oil prices to come down here because of this near-term glut, I think by the time we get into winter 2020-21, we'll be looking for natural gas prices to firm up first. And then if there's a decision by OPEC that they have to cut back production again, and they do, and U.S. production gets shut in because of the low prices, then we could see balance come sometime in the first half of 2021. But the key is going to be for demand recovery is the vaccine. We're going to need to have a vaccine and available readily enough to anyone who wants it. If it's available in November 3rd for President Trump and a few of his buddies so that he can announce it to the world to get reelected, that's one thing. But until you can, put a vaccine in the majority of people's arms across North America and then around the world, the activity, flying and traveling and doing all the things we used to do pre-COVID aren't going to come back. And that, of course, is a big amount of the energy demand that is gone now, which will recover if we get a vaccine in the first quarter, second quarter of 2021.
You mentioned that you thought oil could drop below $30 U.S. a barrel. How long will it take to crawl out of that?
Well, I think it'll be a sharp decline, just like we had in March, April. So my view is the battle at 40 is happening right now. It tried getting above 43. It didn't make it. It's backing and filling between 38 and 41 right now. I expect it's 40.18 last for November, is what I'm seeing on the screen here. And I think we're going to bust 38 in the next week or two. And then the next few weeks, depending upon if we have a wave 2 like's going on in Europe, you can see what's going on in France, in the UK, Spain, where wave 2 has come. And that's been, and lockdowns have occurred again, which means energy demand coming down. The U.S., I think 20 states are having higher caseloads than they had before, according to stuff you read in the news wires every morning. And so if that's the case and wave 2 is a reality, then that is going to cause lower demand, and I think price of crude oil will come down. I expect we'll go down into, let's say, October, November, and then sometime in December we'll have had the bottom. The question is that bottom going to be 30 or is that bottom going to be 24 or 25? I don't see negative pricing occurring because the problem that happened in May or April because of the May futures was due to the hedge funds all being in the front month with their ETFs and their hedge exposure, and now most of them have rolled into longer contract levels, 3 months, 6 months out, and the commodity exchanges are really on it now to make sure that kind of negative situation doesn't occur again. So the low, you saw that when you pull out a WTI contract, they show 650 for the low. I don't expect that either, but I think we may see in the 20 to 25 range if wave 2 becomes a serious reality. Hopefully it doesn't, because of course the number of fatalities would be horrible.
We'll have more with Josef Schachter right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Josef Schachter. Joseph, the TSX Energy Index is now at 67, down from 96 in June when you said take profits. It was a good call then because it's dropped 30%. What do you see from here?
Well, I'm not going to be, people aren't going to like what they hear, but I think we're going down to the lows or lower than we were in March, that 38.80. I've been publicly writing in our reports that I think we're going down to 32 to 36 on the index. The oil, the heavy oil names, the debt-laden companies will have, and the service sector will get hit hardest. But when we said sell in June, we said build up your cash, hold cash, wait for the right buying opportunity. And we expect sometime between mid-November and mid-December, we're going to be looking at one of the best buying opportunities in my career. March was wonderful. The index recovered 150%, and a lot of stocks went up doubles, triples, and quadruples, which, you're talking the golds, that kind of thing, but it did happen in the energy stocks too. And I think the bottom that we reach in because of tax loss selling from mid-November to mid-December will probably be one of the best buying opportunities we'll see in years. And if I'm right, and we do get a vaccine in the first half of 2021 that starts to become readily available, I think we're looking at $55 probably pricing by Q2 and $65 pricing for WTI in the second half. And then in 2022, we could be looking at $70 and $80 WTI. And the reason is simply that, number one, the industry has underinvested so much in there. And two, if they start seeing better commodity prices, they're not going to go stupid and start spending it on growth. They're going to want to get the banks off their backs, so they're going to be paying down debt very quickly. And then shareholders have also been complaining about rates of return. And then so a lot of companies have talked that when they get their bank debt and debt to cash flow down below 2 or 1.5, whatever their target is, that they will then start doing shareholder returns, which means stock buybacks and dividends. And so until past that window, which could be 2022, 23, and things are back to normal and we have consistency of prices in the $70, $80 range, that's when you'll see companies start to spend money on growth. And my guess is that sometime we're going to have a commodity shortage because of underinvestment, and we're seeing it already in the precious metals run. You've seen it in lumber, you're seeing it in copper, and I expect we're going to see grains and others where lack of investment has occurred, and the inflation that the Fed wants is going to come from the commodity board simply because of the lack of production. And that will set the stage for a multi-year bull market in all commodities. So if you're a gold follower, the golds will back and fill here maybe if the general stock market goes down, but you want to be invested in precious metals, and you want to start looking at all the other soft commodities, and then, of course, energy is going to be a big part of it. What's shocking to me is you look at the amount of energy in the S&P 500, it's like 2%. But if you look at it and say, as a percentage of GDP, all of the energy components, you're more like 18%. So it's the most shocking divergence in my career history, where energy is such a small component because of the high component that the techs have taken in the S&P 500.
You're optimistic for the new year. Why?
Well, if we get a vaccine, which I think is likely in Q1, Q2, and more readily available, I think people will go back to normal habits. We'll start going to movies. We'll start going out to restaurants. Travel will probably take off again. And the big thing is that demand was at 100 million barrels a day prior to COVID in, let's say, January, February of 2020. With the capacity right now, probably around 94 million. OPEC could probably bring on another 2 or 3 million by the end, sometime in 2021. But if demand is at 100 and the capacity is 97, then it's, we'll be eating into the inventories. Let's say the total world inventories are 175 million excess barrels in the States and 300 million worldwide. Well, if you have 3 million barrels a day shortage, it won't take very long to eat into the U.S. inventories and the world excess inventories, and that will bring prices higher. And it'll be a while before the industry responds with more production. As I mentioned earlier, they're going to want to get the banks off their debt and their creditors off their debt, off their backs. So they're going to be focused on debt repayments and improving their balance sheets, and hopefully spending money to replace the decline so they can keep the production stable. And then they'll be looking at investor returns before they start thinking of growing again.
California has mandated electric vehicles, new sales in 2035. What does that do for crude long term?
Yeah, I looked at that and did some homework on it, and they're saying that only new cars, the only cars that can be sold that will be new will be, of course, electric vehicles. But, there's a number of things to think about. That would, if that's the case, and you take the number of new cars, but, the average fleet out there is 7 or 8, so there's going to be a lot of cars that are still going to be driving with diesel and gasoline for a long time until they get very old and people turn those cars in and get EVs. But remember, a lot of, stuff that goes into making electric vehicles between the lithium, the batteries, the nickel, how do you produce those items? And that requires energy. So The numbers that net out from the articles that you might lose 250,000 barrels of demand at that time from the California market, but that will be more than taken up, because I think the big focus is we're not looking for much growth in the OECD in demand because of fuel efficiencies, more EVs, more renewables, all that. But the demand growth that might take us from, let's say, 100 million at January of this year down to, let's say, we were, in the 80s and now we're at 92. To take it back to 100 is going to be, just the recovery in the OECD countries. And then the growth to 105 or 110 in the next decade to 2030, most of that is going to happen in the emerging world, which will be mainly Asia, Africa, and South America. And that kind of growth is not impacted what's going on from EV decisions in California. So the bull case is there for because of the underinvestment and because of the bad balance sheets that most companies have, so that they can't get stupid. They have to spend money properly, and that, of course, keeps a lid on bad decisions and bringing on overcapacity, and that means you're going to have quite a few good years before we get to an exit. It's a cyclical business. If you remember, 1999 to 2002 was pretty tough, and we had $10 oil, and then 2002 to 2008 was fabulous, and we went to 147 because China was such a big consumer of energy, and then we got beat up again, and I think this cycle will come up, and I think the at the margin new player is going to be India, because India is now trying to get their economy moving to the level of China, and so they're going to be going from 4 or 5 million barrels a day of consumption to 7 or 8 by the end of the decade, and then other countries, Vietnam and others. So that's where the demand growth is going to come, and the EV situation in the United States, or climate change decisions by our Prime Minister, are not going to have any impact on what's going on in Asia, as you hear many times from the Prime Minister and from other people in the industry who are notable, saying if we can wean China and India off of using coal, that will do more for climate change than anything we do in Canada.
How realistic is it for Canada, that produces what? Less than 2% of the world's greenhouse gases, and it's the coldest nation on Earth. How realistic is it for us to use wind and solar to heat our homes and power our vehicles?
Well, I'm not an expert on renewables, but the amount of capital that goes into it, and the rates of return without government subsidies, they don't stand on their own. The technology is not sufficient for it to stand on its own without government subsidies. And in Europe, you have massive amounts of subsidies for renewables, for solar, and wind. And then, of course, wind takes up a lot of land, and also there's a lot of petroleum products used in creating the wind stations. And ranchers and farmers are becoming less positive and supportive of having wind farms. So the wind farms now are moving more offshore. So renewables have their own problems. So I think that the transition from using coal, nuclear is not going to take over. So natural gas to me is the winner, because it's the cleanest burning fuel, and the industry is doing so much on climate change and CO2 emissions, methane emissions, that we will have a lot, more companies by 2035 and 2040 being net neutral, and that will be a massive win for Canada. And the new technologies that are developed in the Canadian energy industry for the fossil fuel industry, as you might want to call it, will be able to be exported around the world. So while the Prime Minister is now talking about a new energy economy, which is going to be renewables, we are also, because of the success that the Canadian companies have had on being, because of the E of the ESG movement, they are coming up with leading technologies that can be moved around the world, which will also help with climate change, and hopefully the Canadian government will get credits for that because of what we do at the margin around the world.
Why do you think these enviro-terrorists, I call them sometimes, of course, we're all concerned about the air we breathe, but why did they all of a sudden include natural gas with bunker C crude oil?
There's nothing that doesn't have emissions. A cow has emissions. And so, they're just going after it because it's become the focus of, let's get rid of the worst of the fuels, which would be the heavier crudes and and coal, and go to natural gas. And they want to fight the fight where they see the industry moving, and they want to stop natural gas and natural gas pipelines and all the rest of it. But unless we all want to go to a lower standard of living and less travel and an economy that is nowhere as robust as it can be, I think that in the end that's not going to win, and we will see massive increases in the natural gas exports. LNG Canada coming on the West Coast, phase 2 of that, potentially other projects on the West Coast. And if we can send that natural gas to China and India and Japan and other places that are using coal, and they stop using coal, the world wins big time. The planet wins big time.
Joseph, you have a special offer for House Street listeners. Can you tell us about it?
Yeah, we've been talking for quite a while with you and going over our views, and we think that we're getting close to, in the fourth quarter, to a massive and great buying opportunity. So what we're offering to House Street listeners is a coupon code so that they get a discount on the quarterly subscription, which is normally $249, so it's $50 off, $199. And there's a coupon code HOWE, capital HOWE 2020. And if they go into that on our website and put that into where the coupon code is, they'll get $50 off the first quarterly subscription. And what I think is going to happen is that we come through the move here in the sector, and we then get to the lows and the buy signals come in, then we'll be also talking about individual company names, large cap, intermediate, small, oil, natural gas, service sector, and depending upon and we write this as in terms of information. People can then look at it and say, yeah, that's a company I might want to own, or it's a company that I own. I'm glad to own it, and maybe I should add more. So we provide a lot of information. We cover 27 companies right now. Largest companies would be Tourmaline and Whitecap. But the macro stuff we do is also of value. People want to know, because of their own businesses, what's going on in the resource sector. And that's really where we've earned a lot of points, is having one of the better pieces on the macro side, and being cautious in 2014, being cautious over the last number of months, as you know, using the sell word in June, and the buy word, of course, in March. We thought it was a tremendous buying window, and I think we're going to see another tremendous buying opportunity coming up here. So for the House Street listeners, here's a chance to get a subscription at a discount for the first quarter, and get comfortable with it. And then also I expect it'll be during the window when we get that buy signal, so it'll be very important to have the information at that time.
Joseph, thank you so much for chatting with us.
My pleasure as always, Jim.
My guest has been Josef Schachter, founder of the Schachter Energy Report online at schachterenergyreport.ca. He was speaking to us from my birth city, Calgary. And again, he has that special offer, so check it out, coupon code HOW2020. If you have any questions for Joseph or any of our other guests, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.